Welcome to this deep dive. Today, we're looking at the Federal Reserve, the Fed, and really how its decisions hit your wallet.
Yeah, it's a big one.
We've gathered some insights to try and, cut through the jargon. We want to show you why this central bank actually matters to your everyday financial life.
Exactly. The goal here is for you to walk away with a clearer picture of what the Fed does without needing an economics degree.
Hopefully, yeah, because the Fed can feel a bit abstract, can't it?
It really can.
Yeah.
But its actions have very real effects, stuff like your borrowing costs, maybe even the job market you're in.
Okay, so let's start high level. What is the Federal Reserve?
Well, at its core, think of it as the central bank of the United States. It's not a regular bank where you or I would have an account.
Right. Its main job, really, is twofold. Aim for maximum employment, getting as many people working as possible, and keep prices stable.
Stable prices, meaning, keeping inflation under control so your dollar buys roughly the same amount of stuff over time.
Okay, and how do they actually do that? They have tools, right?
They do. Several key ones. The most famous is probably the federal funds rate.
Ah, yes, the one you always hear about in the news.
That's the one. And it's interesting, the Fed doesn't strictly set this rate directly. It sets a target range for the rate banks charge each other for overnight loans. These are loans of reserves held at the Fed.
Okay, so it's bank-to-bank lending, but how does that trickle down to, us?
Great question. When the Fed changes this target raises or lowers, it sends a signal through the whole financial system. It influences the interest rates you pay on mortgages, car loans, credit cards, pretty much any borrowing.
So if the Fed raises that target rate, banks find it more expensive to borrow from each other.
Exactly. And they tend to pass that cost along. So your potential mortgage rate might go up or your credit card APR could climb.
I see. Even a small change, say a 1/4%, that can add up on a big loan, like a mortgage over like 30
No,
years.
absolutely. It can
Yeah.
mean hundreds, sometimes thousands of dollars difference over the life of the loan. So yeah, the federal funds rate is a major lever.
Got it. What else is in their toolkit?
Well, there's also the discount rate. This is the rate banks pay if they borrow directly from the Fed itself. It's usually set a bit higher than the federal funds target.
Kind of like a backup source for banks?
Sort of, yeah. It also influences the overall cost of credit. Then you have reserve requirements.
Okay, what are those?
That's basically the amount of money, the fraction of deposits that banks have to keep on hand, either in their vault or at the Fed. They can't lend it out.
Ah, so if the Fed lowers that requirement.
Banks have more money available to lend, which could potentially lower interest rates because there's more money chasing borrowers. Raising requirements does the opposite, tightens things up.
Makes sense. And there's one more big one, right? Open market operations. Sounds complicated.
It sounds technical, but the idea is pretty straightforward. It's the Fed buying and selling U.S. government securities, mostly treasury bonds, on the open market.
How does buying or selling bonds change things?
Well, think about it. When the Fed buys securities from banks, it pays for them with new money. It's basically injecting cash into the banking system.
Okay, so more cash in the system.
Generally means banks have more reserves, more capacity to lend, and it can push interest rates down.
And selling securities pulls money out.
Exactly. It drains reserves from the banking system, which can make lending tighter and nudge interest rates up. They do this constantly. It's their most frequently used tool to fine-tune things.
Okay, so let's connect this to inflation. We've all felt that recently. How does the Fed fight rising prices?
Primarily by using those tools, especially raising the federal funds rate target. The idea is if borrowing becomes more expensive,
People and businesses borrow less, spend less.
that's the theory. It cools down demand in the economy, which should hopefully ease the pressure pushing prices up.
But that sounds like it could slow the economy down too much, maybe cost jobs.
And that's the tightrope walk. It's a very delicate balancing act. Raising rates to fight inflation risks slowing growth and hurting employment.
Which clashes with their other goal of maximum employment.
Precisely. So if the economy is weak and unemployment is high, they might do the opposite, lower interest rates to try and stimulate borrowing, spending, investment, and ultimately job creation.
It's a constant juggle then between inflation and jobs.
A constant juggle based on loads of economic data and forecasting. There's always debate about whether they're getting it right.
So just to sum it up for everyone listening, the Fed's actions directly influence how much it costs you to borrow money for big things like a house or a car, and also for things like credit card debt.
Definitely. And while we didn't focus heavily on it, These rates also indirectly affect what you might earn on your savings accounts.
Right. Savings rates often move generally in the same direction, though maybe not as quickly.
And, of course, the overall health of the economy, which links back to job security and opportunities, it's all connected.
So the big takeaway really is the Fed matters. It plays a huge role in the economic environment we all live in, and its decisions ripple out and touch your finances directly.
Couldn't have said it better. They're trying to steer that big economic ship, aiming for stable prices and plenty of jobs.
Okay, so for a final thought, maybe just encourage everyone to, pay a bit of attention when you hear news about the Fed changing rates or adjusting policy.
Yeah, think about how those potential changes might filter down and maybe influence your own financial plans, whether that's borrowing, saving, or just understanding the job market.
It's definitely worth keeping an eye on. Thanks for breaking that down.
My pleasure.